For example 1.18, we're going to pay an extra $100 off a month. For example 1.17, we calculated that if an individual took out a $100,000 loan for 25 years, they needed to pay back $758 a month. For example in the end they ended up paying $227,000 to the bank for a $100,000 loan, so there was $127,000 in interest only. For example 1.18, we're going to have the mortgagees pay an extra $100 a month. So instead of $758.61 per month, we're going to get them to pay $858.61 per month and see what difference that makes to the duration of the loan and the amount of interest paid. Okay, so we'll go to function. We're going to start with calculating the duration of the loan. So we'll go down to N per. Now the rate was 7.8%, 0.8% per month, so compounded monthly, 12 months. The payments are now, instead of $758.61, we're going to pay $858.81. And 61 cents. The present value is $100,000, the future value is 0, type equals 0. So now they're paying off the loan over 218 months. We need to divide that by 12 to see how many years. The loan will be paid off in 18 years instead of 25 years. And we need to multiply that by $858. 858? $858.61 to see how much money was paid. So now it's hold on, something went wrong there. So we've got 18 years. Oh, okay, hold on. Okay, so we've got 18 years of repayments, and if we want to know how much they paid, we use the monthly amount, $218.38. So 200 equals $218.38. We multiply this by the monthly repayments, which was $858.61 to see how much they paid altogether. So they paid $187.503. So if you subtract the original loan of $100,000, they're now paying $87,503 interest. So paying back an extra $100 a month means instead of paying $127,000 interest, as these mortgagees did, for example 1.17, they're only paying $87,500 interest. So they're saving $50,000 in interest by paying back $100 extra a month, and they're paying back their loan 7 years earlier.